I will have this as a podcast probably in a couple of days. I've been much faster with the turnaround lately on all your favorite platforms under that Lead Lag Live banner and on YouTube as well. My name is Michael Guy, publisher of the Lead Lag Report. Joining me for the hour is the man, the myth, the legend, Mr. Erik Smolinski. Erik has been hosting a number of spaces himself, was kind enough to have me on several of them. I've never met Erik, but I've gotten to know him a little bit, at least through Twitter, and he's unequivocally a great follow. I encourage everybody here to check out not only his Twitter feed, but also his YouTube channel. He does a lot of interesting stuff. Erik, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get interested in markets? And what are you doing now?
Yeah, for sure. First off, thanks a bunch for having me. I know that you run way more spaces than I can shake a stick at. So thank you for everything that you're doing for the community. It's honestly awesome. And I'm always stoked to work with you and learn from you. For me, I'm originally from New York. Obviously, my name's Erik. And I'm one of those few people that I was fortunate enough. And I started trading like super young. I started trading when I was in high school in 2007. So essentially, Cliff Notes version, I came from a really low income family. I had a single mom that was working 2 jobs. And pretty much as soon as I turned double digits, I started working. I was splitting woods, helping neighbors at their houses, just moving groceries around or whatever. I got into selling Christmas trees for any enterprising person out there. That was like one of the most lucrative jobs I've ever had still. I would make tons of money. I literally came home one night with probably $300 in singles, just tips. And my mom asked me if I was a drug dealer. And Christmas trees apparently are an enterprising drug to get involved in because people are feeling the holiday spirit. It's a good place to make some money. But yeah, so I was working a bunch and I had a high school teacher, actually my junior ROTC instructor, which is kind of like a military training program that you can start in junior high school, 9th grade. And he saw that I was working a bunch and he said, like, what are you doing with all the money? And I was like, well, I'm just saving it all because I don't really know what to do with it. I just know that right now, we don't have money. So I started working to try to help support the family as best I could and pitch in where I could. And growing up the way I did was really formative for me because it led me to be incredibly receptive to input and to knowledge and recommendations. So he recommended that I take a look at investing, and I did. And I got just caught hook, line, and sinker. I started trading typical equities. There was a couple early products I bought back in 2007. You may have heard of a few of them. One of them is Apple. Another one was Netflix. There was Amazon, Kroger. So I had really early success based on dumb, blind, pure luck is exactly what it was. I picked stuff that I saw around, looked cool, did zero research, just bought it with what I had. I started in a custodial account because I was too young to have one. And that's when I really got started with investing. I started trading derivatives probably, 8 months in, because like every young man, I obviously was incredibly patient and willing to let compound interest happen on its own without any further intervention from me. I obviously say that in jest because I still am grossly impatient, but back then it was even worse still. And, I essentially kept trading. I traded while I went to college. College wasn't going to happen, but that same mentor actually got me to apply for a Marine Corps scholarship. So I went to my undergrad at RIT, studied statistics, and had a blast doing it. And I traded the whole time. And then I've traded ever since. And I was actually just starting to work on a video comparing the returns that I've had at other benchmarks. And it's actually kind of really interesting because I'm re-listening to The Psychology of Money, which is an interesting book. It's kind of basic, but I like it. And it talks about this idea of the benefit of starting early. And that's really a lot of what it came down to for me. Because right now I'm 31, but I've already essentially been trading for 15 years now. So just by starting early, I was super fortunate. And I had a chance to really get into detail because of somebody that shared some information with me. The first guy that got me started investing in high school. And then one other guy that was an Army veteran that I met online in just a trading group. And he was a complete dickhead. And I absolutely loved him because he was completely honest with me, shot it straight. And he did not allow me to compromise. He forced me to evolve in a ton of ways. And largely because of the tutelage that he imparted on me is why I've been able to be pretty successful over the past 14 years. I've rounded out with a 22.8% compound annual growth rate, which is, I consider it to be good. It's nothing crazy, especially if you look at US investing championship people and stuff like that. They blow me out of the water. I was just talking with Matt Caruso last week. He had like a 346% return in a year. Like, there's some people obviously knocking it out of the park, but my philosophy this whole time has been get a good return that I can consistently create and keep saving as aggressively as I could early on, and to let that carry me through. Because at the end of the day, one of my largest motivating factors is my mom. Actually, I just paid to get her kitchen redone, bought her car, because she's worked as a contractor her whole life. She doesn't have a retirement. I am the retirement, and I'm totally cool with that. So super long intro, but I purposefully share that because one of my primary messages that I'm trying to get out with people is, obviously a lot of us come from disadvantaged backgrounds, and there are ways about it if we help one another. And that's really what I'm all about.
What did you learn from the Marine Corps that transferred over trading options? I have to assume there are some skills which you really honed in on that are valuable to things outside of the Marines.
Yeah, absolutely. I would point to two primary things. The first one is just ownership, especially because I went in as an officer. Pretty much everything that happened with my unit when I had it, it was mine. And whether it was a dude went out and drove drunk and got into an accident, I'm getting called in because he's my guy. And I'm a part of that, even though realistically speaking, there's nothing I could do there, right? Like, I cannot physically stop him. But the Marine Corps' point there is decentralized command, and it creates a sense of extreme ownership. And I think that that's translated really, really well to trading, because one of the things I see a lot of traders do is say, oh, well, this happened and that's why I lost. Or, oh, I just didn't see that support turning into resistance and that's why there's always a reason why something doesn't go right. But at the end of the day, it's us as the trader that owns it. And we're the only variable we can fully control in the marketplace. So I think that's the first main thing. And the second thing is, cliche as it is, it's discipline. There's plenty of times in trading where I think just about anybody can look at the market and have a position on, and you might want to do something different with that position. But I think that it doesn't matter once you have a well-defined plan. You get yourself down on the right path. And over time, I've created I would consider it a healthier relationship with myself, where I like to say the trader has the last say. So I might see something and make some adjustments on it. And as long as I can like truly justify it, then I'm okay deviating slightly from the plan. But the discipline and adherence to the overall plan is what let me become confident in the ability to deviate like that and essentially continue to deploy as a trader. So those are really the two main things I think about. The first one is complete ownership of everything that happens, because I'm the person that clicks the buttons. And the second thing is the discipline to adhere to a plan over time, even though there's a lot of things that draw you in different direction.
All right. Now, how much of your trading is purely options versus a hybrid of options and stocks? So you're only doing options when you're trading your account?
No, it's definitely a hybrid, but I would argue it's probably like 85 or 90% derivatives driven. And then I have equity positions that either occur as part of the derivatives trades or as just outright positions, which is actually a really interesting conversation we can get into later.
Okay, so what's interesting to me is in hearing the upbringing with your mother, you basically were hustling, right? I mean, you were doing everything you could to get as much money as you could, and you got attracted to options trading. Is it fair to say that part of the allure of options trading is that you can have little money and potentially have outsized gains because of the leverage aspect of it? What is it in particular that, from an income perspective, makes options really interesting?
That's exactly it right there. It's the fact that you gain really healthy leverage. So obviously you can control more capital than what you have. That's actually what drew me to trading in the beginning. Once I learned about investing and I realized that, I didn't need to save up a down payment for a house in order to start flipping houses, which I did get into later in life. But, early on, the markets were perfect for that. And options essentially provided a method to amplify that. Now, the one thing I will say that I think a lot about options, and I'm so thankful that I started trading them even now, where my approach to my account has changed quite a bit compared to what it used to be. And in terms of an income generation tool, there's a lot of efficacy behind trading products like options. And a lot of people, they struggle with some of those concepts, and I don't blame them, because options get a bad rap for a lot of good reasons. Most retail traders blow up when they're trying to trade them. It is what it is. But the thing is once you understand how to use them, one of the coolest parts is I can continually use them to create a income stream. So there's a lot of people that talk about retiring off of dividends. And I always say to them, it's possible, right? There's a couple of levers we have to look at, aka how much your expenses are, how much principal you're going to have. But what I can promise you is, if you and I have the same monthly expense that we're trying to cover, you are going to need an infinitesimally larger, or a significantly larger principal than I will, to be able to make that money via options trading, as compared to just receiving it in dividends. So options give you a lot more flexibility, not just in terms of applying leverage, but also finding market inefficiencies, which I've become way more interested in as I've become just an obnoxious options trading nerd. As you know more than anybody, I've been pestering you to talk about options for a hot minute, because I really, really like this stuff. And the other thing is, it gives you good flexibility depending on, what your investing objectives are. But I will couch all of that with, options aren't always the right product. And I think it's important for traders not to fall discreetly into one bucket or the other.
No, I think that's fair. I like the way you frame that. Now, the thing, of course, with options and leverage is that risk management becomes a whole different dynamic, right? When it comes to options, because you can get creative in the terms of the structure, you can define your gains, your losses. But presumably, I'm going to make the guess that you had a couple of very big options wins that really allowed you to jump, right? Talk about your initial starting capital and what you grew it to, and what were some of the home runs there? Because there's got to be a few of them.
Yeah, so I started with right around $3,000 in 2007. That's how I got just the account opened up. And actually, the first few trades, like I mentioned, and those were God honest trades. Those were some of the first positions I put on, just long equity positions in companies that took off. So that provided an initial boost to the account. And during that entire time, I've always been a hustler. So I was still saving. And I think that that's one of the most slept on aspects for new traders on how to aggressively grow an account. A lot of it is going to depend on how effectively we pay ourselves. How much money are you putting in on a daily, weekly basis? And that makes a huge difference early on. So that was a big part, actually, of what I was doing. But then,
by the way, that means you're subsidizing. And by the way, that means you're subsidizing some of your losses, right? Because presumably you have a drawdown in your portfolio, but you're saving to replenish it.
Yeah, absolutely. And I think that just creating a consistent deposit regimen early on was one of the more impactful things that I did, bar none. But anyways, I did start levering into some of those same equities trades that I was listing. And my initial methodology, it's embarrassing to say, just looking back at it, because it's god awful, but it was what it was. And I essentially was trading what most new retail options traders do. And I was trading far out of the money, cheap options, hoping for those home runs. And some of those same companies, again, that I originally had the equity positions in, I liquidated them for the capital so that I could start trading options. And I essentially just regained entry into those via options for leverage. And those same names were really, really productive to me. So early on, it was mostly tech. And the one benefit of that strategy was leading into 2008, 2009. Obviously, we all know that was a super fun ride for everybody. Because I was trading those far out of the money options, I actually didn't lose that much. When the market started to turn, I actually pretty much got stopped out on the original sets of trades. And then I just flipped to the other side. And that's how I made a lot of money during the 2008, 2009 market, was trading to the downside. So, but it all started exactly as you probably would surmise, via cheap out of the money options, just buying them and hoping for some of them to stick. And fortunately, when I first started, quite a few of them did.
Now, okay, let's talk about that experience from 08 to 09. Were you thinking about it from the perspective of the macro environment meant that you could have these nasty declines? Were you looking at options and saying that there was a degree of mispricing? What is it that gravitated you towards those out of the money options on the downside, the put side?
I wish I could tell you it was as sophisticated as that, but it wasn't. In 2008, 2009, I was 17 years old. So out of the money options were cheap. And that's what it was. I say this kind of painfully because, again, like I look back at it and I think how catastrophic that could have been, but it is what it is. And, I'm just kind of shooting you straight here. But that's what it was. They were cheap and things were going down. So instead of trading calls, I traded puts, and that was it.
Is it fair to say that you, as an options trader, the best environment are ones where there are crashes, where you can get those out of the money puts and really just get some serious convexity? I mean, I've got to assume that the real big home runs come from tail events when you get them right.
100%. That is without a doubt. And the thing is, I mean, realistically, now as I look at the options market, the name of the game is volatility. I always want to see volatility because if you trade options, you have a perspective on volatility. A lot of people don't understand that. But if you don't have a perspective on volatility when you're trading options, trade the equity, because otherwise, what are you doing? But in terms of creating those significant, like 500 to 2,000% return on invested capital trades, that's exactly where it lives. In those far out of the money options, again, like it's essentially lotto tickets. And I was super lucky. And I want to be abundantly clear about that, because if I was starting over again, that's not what I would do. It just happened to be the way that I was viewing things at that point in time. And I was super fortunate when the market first started to turn, because I had a bunch of different small positions on, and I essentially lost on them all because I was just long. And as soon as I saw the market turn, I was just using like simple moving averages at the time. And I was like, oh, well, it's inverted now. And I've seen this happen before because I was studying previous markets. So then I just, because at that point I was essentially Copernicus to myself, I was like, I can see the future. We're going down. And I just switched to the far out of the money put sides. And those are the options that really give you this serious compounding effect when you get the move, right? If you don't get the move, then you're just slowly bleeding out, which is more often the case than not. It was just the time that I decided to start trading the market, and I got blind lucky, at least for the first few years, I would say.
Yeah, no, so that's an important point. So if you're going to play with out of the money options, to your point of the lotto tickets, the problem is, of course, you keep losing, and you have to hope that you're close enough in time for the tail event to hit. Exactly. For that event, right? For that convex type of profit trade. The problem is that can be really hard mentally, right? On an options trader, on an investor. I mean, how many portfolio managers or sort of gurus were playing out of the money puts on the stock market at the peak of the housing bubble in 06, right? And then 07 and right. nothing, and then 07 and nothing, and then 08, and then finally it works. But do you even have the mental capacity to stick it out that long? So how do you manage through the inevitable periods of the slow bleed, which will happen to everybody?
Well, to be clear, there's kind of two discrete time frames as far as I consider the conversation on the strategy. Early on is one period of time, and like the way that I trade those periods now is very, very different. I really, most of what I do now has become boring, but in like the most possible good way boring. Essentially from 2008 is the only down year I've had. And everything after that has essentially been either at pace or most years slightly or dramatically exceeding the market on a few of them. And I have evolved my strategy greatly from I only know how to trade things via direction. I want this to go up or I want this to go down. And it turned way more into creating a toolbox that allows me to look at the current markets and figure out the right tool to apply to the current markets, because that has been probably the biggest evolution of my trading from when I was in college trading. I started to kind of crack that code a little bit, so to speak, because while I was trading the current markets, I, again, am a pretty big nerd on this stuff. And I've spent a lot of money and a lot of time buying data to back test so that I can not only get rough backtest data, from whatever free software you can get, but I can actually start codifying like specific concepts, specific tools and controls, and see how they do. So I started doing that essentially when I was in college so that I could define more definitively what I thought would work in different markets. And that's been my approach thus far. So to answer your question in a summation statement, I don't really have those periods anymore because I'm not really trading far out of the money options. I do it sometimes for tail risk management, but other than that, I don't really slowly bleed out pretty much at all. It's just not part of my strategy as much.
All right, let's play with that point you just said about back testing and trying to figure out what works in different markets, because this year, I don't care what anybody says, has been a market like no other, right? I mean, I think
I agree.
Those that are in the business now, I think it's increasingly clear, right? I was hammering that but back in March, saying this is worse than 08, worse than 2020. Depending on how you measure the S&P's performance on a real return basis, it's like one of the worst years in history. The sequence is very bizarre. We know what's happened to bonds. And volatility really hasn't had that spike, right? Which is also a little bit odd, even in the way that the market itself, the stock market, has behaved. So my response in environments like this is, if it's an anomaly, which is my belief, it's been my belief for a while, the best thing you can do is simply wait, for it to turn, because you don't know when it's going to turn. But if it's an anomaly, it's probably not going to last very long. How have you managed through a year like this from an options trading perspective when there really is no precedent?
Yeah, it's a good question. And I would slightly push back, and I wouldn't say that there is no precedent, but to your point, I wouldn't say that there's any direct precedent. Like there's nothing, again, to your point, that's like super similar to what we've had. But what we certainly have had previously is, high inflation years with rapid rate changes. So we can use early 2000s, some of the mid 2008, 2010 timeframe. We can use some of the late 80s to at least get some ideas. But for me, this is actually been a very productive year. I don't think I'll surpass last year. Last year return I'm looking right now was 24.85% return on the account. So slightly behind the market. But this year so far, I'm up 17.4%. So in a year like this, when the year first started out, anybody that is on the YouTube live session, I joke about this. I do one of those every Monday. And I was essentially just saying how little I trusted the market for this exact thing. So as soon as I started seeing small anomalies pop up, exactly as you said, I did exactly what you think the right answer is, which is kind of funny to me because we didn't talk about this first. And I did go to cash, and I sat in cash a lot of the year. And I was still deploying slightly here and there, not too much, definitely less than essentially 20% of the account for most of the year. And in the last few months, when things started to make a little more sense to me, is when I've just been getting a little bit more aggressive. And the cool part about trading options is, despite the fact that pairs trading right now, you would get killed on because, again, like you were saying, the relationships aren't the same. But what is the same, and what is always the same, is the way that volatility acts. We can have a market that does anything, and we could, say, okay, well, I thought maybe the VIX would go higher, or I thought volatility would stay clustered higher, whatever variation of that is. But none of that changes the fact that volatility has certain behaviors that have always been observed. So things like heteroscedasticity is one of them. Same thing with the clustering components and then the mean reversion components. So throughout the year, essentially, as I saw any glimpse of light into opportunities to trade those movements, that's exactly what I just piled into. Because again, like you're saying, and I agree with you, the market, the last few years, honestly, has been kind of weird to me. But I don't know. I always think it's always kind of weird because you always think you kind of have it figured out, and then it starts doing some weird thing like we're seeing now, or during the COVID market, like that bottom, that V bottom out, that took me for a bit of a surprise. But what I do is, when I'm uncertain like that, I size down a lot, and then I will tinker by deploying small variations of different strategies, see what starts sticking. And then when I start to see what's working, I just, reallocate funds over to that and scale in. That's actually one of the most beautiful things about being a retail trader, is I have that luxury. We talk about your fund sometimes, and I always think that's really tough because you have a prospectus essentially that you have to deploy against, and it's based on rules that have been observed and those typical relationships, and sometimes they're not the same. The cool part about being retail, one of the few cool parts, is I can just pivot, which has been pretty good actually.
Right. And pivoting when you're discretionary in your trading style and a professional, right? And you know your stuff, obviously is a huge advantage. But you know about it being weird the last couple of years. Is it fair to say that the interest among retail in options trading actually resulted perhaps in more mispricings, more dislocations, because it ended up being more about sort of get rich quick type of thinking rather than thoughtful structuring of options trades. How does the influx of retail options activity factor into whether the price of an option is right or wrong in your view?
That's a fascinating question. I don't have any discrete data against it. I do a lot of studies, so when I can reference data, I try to. But there are a couple studies that I haven't done myself. You can find them on SSRN. And then after this, Mike, I can pull a couple of them up to share with you. I was actually talking with Ewan Sinclair Friday, he's written a handful of options trading books. He's a PhD. He has a 10-pound brain. I love talking with him, and he's really big into trading volatility. So that offshoot aside, there's been a notable impact on retail traders piling into options. The problem is for people like me, I don't have algorithms that can move fast enough to find most of those very, very short-term mispricings. However, I can observe volatility and the way that it's behaving and find products with a higher propensity to be mispriced. And that doesn't just come from people trading options, thankfully. That actually also happens when traders flock into smaller equities products to trade the equity outright. So you'll see a lot of people like me that have a fair size of our book tied up with volatility trades, and we'll be in a lot of biotech and things like that, where the options markets are kind of sloppy, not my favorite, but that is where there are a lot of opportunities. And that's been actually one of my go-to strategies so far this year. Is I've been doing a lot of shorter term volatility plays in the indices. And I talk about that one openly because everybody knows about the indices. I'm not giving away any sort of, edge there. But there are like specific names that I've been playing pretty successfully. And it's a mix between just variance risk premiums and pricing inefficiencies for sure. And I'm more guarded over sharing those names just because some of them honestly are pretty small and they can get moved fairly quickly. I've actually seen it happen to a handful of those names this year. But I think by maintaining flexibility in terms of what I'm deploying in, that's where I stand to interface with the opportunity that retail traders bring as they start piling into the markets. But the problem with retail in general, again, you probably know this better than myself, is just how sporadic and random it is. So one of the interesting things I started doing was there's a lot of different sentiment indicators out there, but I've been tracking for the past 2 years. The study is not ready yet, but I've been tracking for past 2 years the impact on open interest, which just means how many options contracts are open at a given point in time. I've been tracking that against what's been trending on places like Reddit and Wall Street Bets to see if I can find a discrete relationship. I surmise that there is one just because looking at prelim data, I can see some anomalies that occur, but I don't have any, finalized outputs yet to specifically cite the exact impact, but I do think there is one.
Just for the remaining hour here, let me reset the room real quick. Everybody that's here, first of all, make sure you follow Erik on Twitter. He's also got a great YouTube channel. I've gotten to know Erik a bit the last several months here. Really is a phenomenal person, and I think is very intellectual in the way he looks at the option side of things. Again, this will be a podcast on the Lead Lag Live banner. All right, Erik, you mentioned biotech. And this is, I think, kind of interesting when it comes to options because it's not really my world, but I'm curious, are there just certain sectors or industry groups which are better for different types of option strategies? So rather than just saying options in general, in terms of structuring, in terms of liquidity, in terms of volatility, what are some of the go-to areas that you focus your attention on?
That is like a question that hits my heart. It's like one of the funnest conversations, which I know for a lot of non-options traders, they're just like, yeah, okay, dude, how could that be fun? But it's so freaking awesome. So there are absolutely different places I like to play different kinds of strategies. And it's for some of this periodicity that we're talking about. So if I'm looking for more volatility style plays, I like to look for a catalyst. You can find catalyst in open market environments. Earnings is a very common one. The Fed releases has actually been a very productive one so far this year, and biotech. And the reason why biotech tends to have just a lot of catalysts is because they go through a ton of different trials. A lot of biotech companies are very lean, meaning they need those trials to go well. Otherwise, there's typically not a great outcome for them. And stuff like that can be really useful to find a catalyst if we want to trade volatility directly. Now, you could trade those events if you follow how they are, reporting their trials and things like that. I personally don't do that. I stay loosely connected just because I think it's interesting, but it's nothing that I'm trading off of. When I'm trading things like biotech, it's almost always volatility. If I want to trade something, and that's specifically when I say volatility, I'm talking about mispricing volatility. And all that simply means is there are two types of volatility we typically will look at: implied volatility and historic volatility. Implied volatility, as the name, check me out, implies, is forward looking in nature. So it's a projection. We don't know what it is. We're guessing. We're trying to use what information we have to see what volatility should be going forward so that we know how to price things. And then there's historic volatility or realized volatility. We'll flow between those synonymously. And that's just how did things actually move. So when we're around a catalyst, we know volatility tends to move, and we can see historically the relationship between implied volatility and historic volatility. Then we can price implied volatility and see if we think we have a edge to be found there, meaning that the options are slightly mispriced with too much or too little implied volatility. So biotech is a great place for that. And there's a bunch of other strategies that I typically will play in less volatile markets. I like to trade index ETFs a lot. Anybody that follows anything I do will probably know the words IWM by heart now because I trade IWM so freaking much. It's probably one of my most traded tickers. And a lot of that is also because, again, my trading philosophy has changed quite a bit. I was going through a very aggressive growth phase in the account into like my mid-20s. And as I started getting closer to where I wanted to be, I've started becoming more conservative. Still, I wouldn't call it overall conservative, but more conservative than I had been. And that's why products like the index ETFs take up a pretty big part of what I'm doing now. So if I want to trade, volatility, those are the kind of things I would look at. If I want to trade positive earnings drift, which is another documented effect around earnings that we can observe and apply forward-looking projections on, those are other great ways to trade the same catalyst being earnings. And then really, I can harvest variance risk premiums in large index ETFs. It's less effective than it used to be because a lot of people know about it now, but it's still effective enough that there's a small edge to be had when you're paying attention to volatility. So again, very long answer, but the short answer to your question is there are definitely things that I prefer to trade based on what kind of hypothesis I'm trying to execute on, or if there's a certain risk profile I'm trying to find.
All right, you got to help me with this, Eric, because I'm really blown away that this is a thing and that it's as popular a thing as it is now. The 0 days expiration
Love it.
options, right? And I'm serious when I say this. So I'll preface this by saying, to me, that really feels like gambling. I mean, I'm not a huge fan of day trading just because there's a lot of evidence that suggests that most returns come from overnight closes to close or closes to open, not open to close. And it seems like this is almost trying to bring out more of a gambler mentality. But tell me I'm wrong, and tell me how you view this kind of move towards 0 day expiration options.
Well, I think you're right and you're wrong simultaneously, to be honest. I think you're right in the fact that the way, again, that most retail traders would trade 0 DTE strategies, it's probably exactly that. They have this completely bullshit notion that if I stay in and out intraday, I'm experiencing less risk. There's a million things I could point wrong with that. I'll spare everybody the soliloquy, but there are a ton of problems with that style of deployment. Now, that being said, again, I was talking with Ewan Sinclair on Friday, and he and I both actually really like 0 DTE plays. But there are a lot of criteria that need to be assessed and met before they're played. So, for example, if I look back at the last week, I'm pulling up IWM and SPY. For almost all of last week, realized volatility came in higher than implied volatility. As soon as that happens, 0 DTE, any sort of short premium style where we're selling options, it goes right out the window. Your edge is gone. You are just waiting to get ran over and you're not getting paid for it. So 0 DTE options can also be some of the most mispriced options depending on what you're trading. So a lot of those individual products that I was just sharing with you, if I can find very short-term exposure, that tends to be super overpriced. So there can be really, really great opportunities in those short-term timeframes. The problem is most retail sees it as, oh, all I have to do is make $100 a day. And that's easy to do because it's a seemingly small dollar amount. Meanwhile, they have a $10,000 account and they're, if you do the math on it, they're essentially wanting these insane returns disguised as a small raw dollar figure per day. They find themselves into these short-term strategies, which I actually have a few videos that talk about them, because even the way that retail traders construct them, in my opinion, very frequently are silly. Because if we're saying by selling premium, we want to capture the variance risk premium. We're saying that implied volatility is expensive compared to realized volatility, which is relatively cheap in this example, except they want to trade something like a short iron condor. It makes no sense, because the same thing that we're selling because it's expensive, we're buying something in that same exact environment that we're saying it's too expensive. So I feel like a lot of retail traders have just a completely backwards approach to trading things like 0 DTE plays in general. However, I will say that they can be very lucrative. It's actually been probably one of the primary drivers of my returns for the year.
And how's the liquidity there? I mean, I see the volume is quite high, but are the spreads fairly tight? How does that trading aspect work?
Depending on what you're playing. So if we're in any of the index ETFs or the indices themselves, SPX, RUT, things like that, liquidity is absolutely fine. Tons and tons of liquidity. In these biotech stuff that I'm listing, it can be absolutely abysmal, awful. And you're getting taken for a ride on both ways, in and out. And yeah, the liquidity in those, especially as the volatility starts to spike, it can be really, really awful, to be completely honest.
Yeah, and I'm gonna make the assumption that you'd probably say to anybody listening to this that you shouldn't be playing with that unless you're really experienced in the options world.
Completely agree. You're waiting to get your head taken off, because the thing that a lot of retail traders do that I think leads them astray is, they think, okay, the bid ask spread is kind of wide, and okay, I'll just get in now. I'll take the haircut. But what we don't really fully appreciate is the haircut turns into a neck cut on the way out. When volatility expands, the bid ask spread is huge, and then you can't even get in line to get through the door at anything resembling a fair price. So couldn't agree with you more on that.
All right, now let's talk about some of the misconceptions that you've seen people have when it comes to options trading. Again, to me, this is all a very interesting conversation. It's a different style of generating returns. My father used to play with options and was a fan of them, but he always made it clear to me that you never want to play against time, which is always the problem, of course, with options, right? You're playing against time, unless you obviously constantly roll it over. But what are some of the misconceptions that people have when it comes to options trading in general?
It's a good one. And I think there's a handful that come to mind. The very first one is that some people I've seen seem to believe that if you trade options, you inherently now have an edge because you're trading options instead of equities. And it's obviously completely false. Options are just a vehicle to express a different style of hypothesis. But inherently as a product, unless you're discerning to figure out where the edge is, there is no edge. There's nothing that makes an option better or worse than an equity product. There's simply different rules that apply to it. So that's one of the first main ones I would point to. Another one that is becoming increasingly frustrating to see in the past few years is there's been a couple larger retail facing education sources that I actually like some of them, but there's a lot of retail traders now that are just looking to sell premium, and they think that because they're selling premium that they've now found an edge, which again, to your point, like your dad was telling you, playing against time, people take the inverse of that and they say, well, I don't want to play against time, so I will become time. And again, there's a trade-off with every single thing we choose to do as options traders. If you are fighting time, meaning beta is decaying out of your positions, you are now long gamma, which is really the main payoff. That's the trade-off you're making. And it's obviously the inverse if we sell premium. So things like selling premium doesn't create an edge. Trading options by themselves doesn't create an edge. Even taking the time to write out like a trading plan, which I am a huge advocate of, taking the time to like physically write out a trading plan and complement it with a trading log. If you go through the dozens of hours it takes you to do that and it's really, really good, guess what? That's still not an edge. The problem here is the most important thing we need to find as traders, first and foremost, is edge. And then we need to create all the supporting infrastructure to realize that edge. And a lot of traders, they'll say, oh, well, I hang my hat on because I believe in trading psychology and I'm a psychologist and I know all about myself, so that will make me money. And I honestly disagree with those people. I think it can help you keep your money for sure. It can help you make more money. But your psychology in and of itself is not an edge. We need an observable edge if we're going to actively trade. If you don't have an observable, quantifiable edge, just passively invest. There's nothing wrong with it. And for a lot of people, it's a good answer. And the last thing I'll add to that is even for the people that choose to passively invest, we can use options to amplify the way that we deploy to take advantage, add small hedges here and there. And it still has a place in just about everybody's portfolio once we understand how they work. But all that being said, a lot of people have this idea that they're getting all these different edges from trading options, and it's just not the case.
Let's talk about some of the favorite option structures or strategies that you tend to turn to the most, right? Everyone's got some kind of favorite signal or some kind of favorite time frame, whatever it is. What are yours?
My favorites are typically wrapped around volatility in some way. So I like to trade short straddles. Sometimes I will dynamically delta hedge them. Sometimes I won't.
Well, hold on, sorry. And let's define delta hedge and straddle. Let's just for the audience explain what those are.
Yeah, sure. So a short straddle is just when we sell typically in at the money we're trying to get is equivalent of a delta as possible for the call and put. And it's typically, in the same expiration. So the way that a straddle works is when you sell a straddle, you receive a credit up front, which is just money, cash that gets deposited into your account. It's similar to shorting a stock in the transaction sense. And really, when we sell a straddle, we just don't want the underlying to move that much. As long as the underlying moves less than the credit you receive, you've made money. Good job. And then you move on. So straddles and strangles, short straddles and strangles are some of my favorite ways to play volatility. And the only difference between a short straddle, which again, the same strike, call and put, that's short in this instance. A strangle is the same construction, but they're not at the same strike. So you can sell and kind of create like a larger window, quote unquote, for you to be right where the short strikes are. And they're just two different ways to play the same thing. But I like to trade those for volatility, but I also like to trade things like the covered strangle is my hands down go-to strategy almost always. I almost always have some sort of exposure in the covered strangle, which going back to one of the very first questions you asked me, that is one of the primary ways I gain exposure to equities products is via the covered strangle. And beyond that, I do like to trade diagonals, which is kind of a way to gain synthetic exposure. It's like a covered call, but instead of buying the underlying, I'm using options to be the underlying. And for newer traders, to round out some of my favorites, like if I was starting over again, I would really focus on things like just a cash secured put into a covered call. And I think those are like two strategies that can fit into almost any trader's toolkit once they understand how they work to help amplify annual returns and reduce risk, because everybody thinks that options just increase risk, and they can, but they can also reduce risk if we understand how they work and create strategies that align more closely to whether you want to expose yourself to more risk or less risk.
So I'm never myself a fan of paper trading, right? But you've got to try something, right? But nothing's quite like obviously putting real capital at risk. And you always hear these lines about how people say, well, if you're a new trader, the best way to learn is by just starting, right? Yeah, you can read, but nothing will beat experience. I have to assume though that there's got to be a caveat there when it comes to options trading, because the likelihood of making a cataclysmic mistake is a lot higher, right? Given the leverage in options. So for newer traders that want to get into options trading, how do you recommend they approach it? Because it really shouldn't just be the case where they try it out and learn, because that can be really disastrous.
Yeah, I couldn't agree with you more. I'm actually a huge advocate of paper trading. I think it has its shortfalls, as you kind of already overviewed. But the way that I think about testing any strategy, I will back test it first. That gives me a large sample size to create just reference points, and it lets me rule out things that are completely busted. Right? Common saying is, if you can't make, well, who doesn't have a back test that looks good, is like a common saying, right? Something like that. And that could be the case. But the thing is if you can't get something to look good in a back test, then I typically have found that I'm just wasting my time entirely. So I'll start with a back test, large data set, you get an output. From there, I'll codify it in a trading plan by writing the rules that I intend to deploy and how I intend to observe how it plays out. And then that's when I will start paper trading it. And to your point, paper trading helps me create a slightly more nuanced data set, way more time consuming. And paper trading will never, ever, ever fully replicate the actual effects of trading. But it's like the same thing we say in the Marine Corps. We sweat more in training so that we bleed less in combat. It's the same exact idea here. Instead of bleeding blood, you're bleeding money. So that's why I really like paper trading. I view it as training, just like I do in the Marines, but instead of, seeing how it goes and hoping that things play out, I can create a loose data set. Again, not to spend a ton of time on it, but I can create a loose data set to further confirm or deny if it's worth adding any capital to it. And that so far has been a really efficient and effective approach for me. And it also forces me, and I think this is why it's good for a lot of new traders like you're referencing, to take the time to write out a trading plan. It is one of the most uncomfortable things to do early on, because it's a blank piece of paper and you have no idea what's supposed to go there. And the way that I always respond to that is, why would you think trading is going to be any easier than that? So by taking the time to write down those thoughts, I think we have the ability to validate a hypothesis and then to test it loosely before deploying it. So I think paper trading for new traders is a really, really useful tool. It just has to be understood and understand the constraints. But just because it has constraints doesn't mean it's not a useful tool.
Let's get some of the audience.
I view them as slightly different hypotheses. So when I'm trying to trade something like a calendar spread, there's a more distinct risk I'm trying to gain exposure to. When I'm using things like diagonals, it's essentially replicating, like I was saying before, like a covered call. Whereas a calendar spread, I'm really playing more of a volatility assumption as compared to a directional assumption. That's really the way that I would bucket those two. Generally a different hypothesis, because the way that I set up diagonals is I create a delta ratio so that I don't cap my upside. So again, it essentially behaves just like holding the equity and selling calls against it, but not enough to cover the upside. So it's an undefined profit trade for me, realistically, the way I set up the diagonals versus the calendars.
Okay, so I was going through some of your blog posts as you're speaking, and one of them that you wrote in July, I think, is worth hitting on. We said trading options isn't for everyone. And you mentioned, the Marine Corps, and I'm sure, there's an aspect of the Marine Corps that's also not for everyone, right? It takes a certain kind of personality, certain type of way of thinking about and approaching problems and solving those problems. What type of person should or should not be an options trader? Let's talk about the sort of ideal personality for somebody to do options versus not.
Man, that's an interesting question. I obviously only have an opinion. I don't have a data-backed answer on this one, but I would point to a few things. I think the first one is naturally inquisitive. For people that are, and unfortunately, a lot of options traders, myself included, if I'm being honest, like when I first started trading options, it was to make money fast. And it's a awful basis to start trading derivatives because they're such nuanced products. That's one of the most difficult things about trading options is I can be correct in terms of my direction, but lose money on the trade because volatility moved, right? Or I could be right in my volatility prediction, but be wrong because it moved directionally too much one way or the other. That is the most difficult aspect of trading derivatives is you're now exposing yourself to an entire additional risk profile in addition to just direction. So all of that is to say, I think that a successful options trader has to be willing to put in the time to understand the product's work and continually question themselves. Because when I made my biggest losing options trade, I had been trading options for like 4 or 5 years at that point. So I definitely consider that a bit of the Dunning-Kruger effect that got me real good. But it was also just a function of I kind of knew what I was doing, but I obviously still had more to learn. And I look back at that trade and I cringe at it. And it's for a lot of these reasons. Options are very dynamic products that have a lot of rules that go with them. And they're misleading because it's so easy to start. It's kind of like anybody can pick up a basketball and shoot hoops in their driveway. But that does not mean that you're ready to pick up a basketball and go run around on an NBA court. And that's not to create this comparison as if I think I'm commensurate with a professional level trader. I'm nowhere near it. I'm just a retail trader carving out a small space where I can find some edge and deploy consistently over time. That's been my general approach. So I think the main thing for any sort of derivatives trader is intellectual curiosity. And that obviously has a ton of sub factors that have to go with it. Discipline is without say, and you have to be methodical. That's one of the most overlooked components of being an options trader is if you aren't able to look at something that has a bunch of different variables and begin to isolate what variables do what and how when you craft a plan that impacts the outcome and identify what variables are creating those variances, it's going to be real hard to create a successful strategy if you want to trade options like primarily. Again, I will go back to, and this dovetails into the inverse, like who shouldn't be trading options is anybody that's not really willing to put in that level of effort if you want to trade options primarily. If you want to use them as an amplifying tool, I literally think anybody could open up a brokerage account, start buying the same stock or ETF that they always would, and sell a couple covered calls against it. Like that is completely reasonable. More often than not, they'll happen to be selling covered calls when IV is higher than when implied volatility is higher than historic volatility, because that typically is the case. So, if they sell cash secured puts to buy something that they want to buy, they buy it and then they sell calls against it. Super common strategy. And I think that that's really accessible to a lot of people. But if you want to trade options more regularly, it's so important to take the time to understand how they truly work. And most of us put the cart in front of the horse. I know I did. And I spent actually like really a tremendous amount of time studying them before I even did that. So I think the people that should be trading them, intellectually curious, willing to take the time to control for variables and observe results and optimize. People that shouldn't, people that are just trying to get rich quick because it's just a way to blow up quick.
Yeah, actually, I'm glad you mentioned that point. I've made that argument before. This is perhaps the only domain in life where you can be right and lose money or wrong and make money, right? But being right on the signal is not enough, especially this year, because the execution of risk off is what fails so miserably. We'll see if that's going to change, hopefully sooner than later. But that's a really hard thing for people to get their mind around, right? Because in most professions, most endeavors, there's a clear link between being right on something and then seeing the positive effects of that. Whereas in this business, sometimes it's not so linear, that connection.
I think that's fair. Yeah, I think that's completely fair. Options don't like to move. Yeah, there's so many inputs that go into the way that they move. It can be extremely frustrating.
For the remaining couple minutes here, Erik, and again, everybody please make sure you follow Erik on Twitter and check out his YouTube channel as well. I always like to ask this question because I think it's a good one for newbies and those that are pros, but what types of material do you think people should be looking at when they really want to get better in options trading? I'm going to make the assumption that aside from your YouTube channel, there probably are not that many YouTube channels that are worth paying too much attention to. But What was your self-education like in terms of what kind of books you read or what type of material you studied?
Options as a Strategic Investment by Lawrence McMillan. I think that's the go-to for anybody that wants to touch an option. I think that's a book that is essentially a must read. It's kind of brutal. It's a big old textbook, but I think that that is one of the very first ones I would point to. And then the second one I would point to is Positional Options Trading, which is Ewan Sinclair's most recent book. That one I would say is more for the more serious option trader, just because, again, Ewan is a PhD, is kind of a math head. So you're going to see a lot of math in there that can be intimidating, especially for the people who aren't used to statistics. But nonetheless, I think both of those are primetime reads.
Very good, everybody. Thank you for joining, Erik. Always enjoy listening to you. I think you're a very well-spoken person, and more people should pay attention to people like you when it comes to this industry and this field and on the option side. If you ever want to launch an ETF, by the way, let me know on a side note. And everybody, again, I appreciate those that are joining. Thank everybody. Enjoy the rest of your night. Thank you, Erik. Really do appreciate you.